Well, thank you all very much, and it is a privilege to be here talking about exorbitant privilege with all of you and this great group of guests here to my right. And I want to pick up with what was said at the end of Francine's conversation about the great realignment, and that is that this debate over dollar dominance is not a new one. It's been going on for many decades, and there have been these kind of signal moments along the way. I think at the advent of the euro, China's efforts to get included in the SDR and internationalize its currency, global financial crisis, COVID, the list goes on and on. Jenny, I'll start with you. I'm just curious, does this moment, when you think about the primacy of the dollar, feel notionally different than those?
Look, dollar dominance, I always come back and say, well, where else are you going to go, right? So start with that. And, you know, if you think about the reserve currency, you're looking for stability, you're looking for strong economies, you're looking for a trust. You have to have a free-floating currency. Capital, you know, you can't have a lot of capital controls. So I don't think there's a question about the dollar dominance. I think there's a question about how much it gets chipped away, right? And you definitely see that. And you see that. And honestly, I actually think there's a lot of discussion about how tariffs and can you trust the U.S. has impacted it. But I actually go back to, in talking to some central banks, you know, when Russia invaded the Ukraine and the U.S. froze assets of Russia in U.S. dollar, there was this, oh, this could be us. And so I actually think it started a little bit there where people said, okay, we need to start to diversify this a bit. And then you've obviously had the comments on, you know, how can we trust the U.S. in how they behave in certain ways. And you see it, right? You see, like, when when Russia was taken away from SWIFT, you now see contracts being done. India's buying oil from Russia in rupee, you know, denominated invoicing. China and Russia are operating in the yuan. So that's the chipping away component. You still have the dollar dominance.
Valerie, let me bring you in because you've been living this day to day. Jenny talking about sanctions, and you are sitting on these frozen assets from the Russian central bank, and everyone trying to figure out what can become of those. What is your sense of the role that sanctions policy, the aggressive use of sanctions, has played here in kind of the reconfiguration of currencies globally?
Well, I think we understand all the objective of the sanctions. And I think in the context of the Russian-Ukraine war, I think the objective was very clear. But I think one thing that often politicians do not always understand is the long-term implications of those sanctions. In the short term, I mean, it makes a lot of sense. But, you know, there is an erosion of trust, which is really driven by those decisions. And I believe that, and that's part of the role that I play for the last 3 years now, is really to educate, to some extent, the politicians about the consequences. I think also another thing which is very important, and especially in the current world of uncertainty, is that continuing to defend and respect the rule of law, you know, the legal certainty is key for the trust in the financial markets. And so, yeah, sanctions, I mean, always there are different sides to the story, and practitioners who are there to really highlight what needs to be protected, and definitely the legal regime must be protected.
Danny, I want to ask you about the role of Washington in all of this. And I was thinking back on something that Hank Paulson, friend of the Forum, former Treasury Secretary, said a few years ago, that the greatest risk to dollar primacy has less to do with what's happening in Beijing and more to do with what's happening in Washington. So we're at a moment now where there is this aggressive trade policy that Jenny brought up. We have a Congress that passed a tax and spending bill that's going to add $4 trillion to the debt. We're seeing that ratio of debt to GDP growing to 150% here in the next few years. What do you make of that? Is there just a level of complacency in Washington and among investors as we see those numbers continue to rise?
Absolutely. I think on that front, you know, the U.S. today is running a fiscal deficit of between 6 to 7%. The last time the U.S. ran a deficit above 5% was World War II. And then it was the GFC in 08-09, and then COVID, right? But today, the CBO estimates that the U.S. deficit will be above 5% for the next 30 years, with the S&P close to lifetime highs, with the U.S. close to full employment, 5%, right? So, you know, to your point on, are they pushing the limits? You know, it's one thing that would be, of course, you know, worth discussing. But I guess the alternative is, what choice do they have? You know, on the topic of de-dollarization, we've been, you know, talking about it for many years now. Right? And I think, first of all, we have to go back a little bit further to 1971 at the end of the gold standard and of Bretton Woods, right? And I think it's kind of boring to go so far back, but you kind of just need to set the stage, right? So back then, the U.S. government debt at that time in 1971 was about $380 billion. I mean, that amount is like the one-day mark-to-market swing of the, you know, Mag 7 and the stock market. Like 380 billion. Today, it's 38 trillion, as we all know. It's grown 100 times in the last 54 years. And coincidentally or not, gold prices at that time was $40, and today it's just over 4,000, also 100 times. Right. But like I said, 54 years ago, kind of boring. So let's bring it closer. So 10 years ago, you know, and I think you can see de-dollarization from this point. The IMF data, you know, basically about the composition of official foreign exchange reserves, said that the U.S. comprised 66% of all reserves globally 10 years ago. Today has fallen to 56%. Where the euro has gained 2%, China has gained 2%, the yen has gained about 2%. And also 10 years ago, the dollar index, which is a measurement of the US dollar strength, was at 99.5. Guess where it is today? 99.5. It hasn't moved, right? So on that basis, you'll be like, hey, you know, there's no de-dollarization, even though the weights have come off, but the dollar hasn't weakened somehow. But that's one part that is missing. This FX reserves that we're talking about doesn't include gold. If you add gold to it, using the numbers from the Gold Council, you know, of reserves, then 10 years ago, the dollar component, including gold in the whole basket, would have been about 57%, and gold would be, what's that, 13%. Today, the dollar has fallen to 42%, and gold has almost doubled to now 25%. And if you look at the price of gold from 10 years ago, it was just over 1,000. Today, we're at 4,000. It's gone up 300%, right? So I'm saying that de-dollarization, or maybe to be more fair to the U.S., it's about a move away from fiat currency, right? Because it's about a competition of who's less ugly, right? I mean, like every country is doing a lot of, you know, basically the fiscal ill discipline that you talked about in Washington. It isn't just confined to the U.S., right? It's confined to many of the Western nations.
Valerie, on that point, how competitive environment are we in right now? Again, there have been moments in the past where you've seen China take a more aggressive tack. Perhaps this is an opportunity for Europe, looking at what's happening in the U.S. Is it a moment of global competition, or is this a moment in which other countries are content to sort of watch the U.S. go down this path, see central banks changing the composition of their assets, and just see how this evolves? How competitive is the environment as you see it?
So given the franchise that we have with central banks and the fact that we cover, I mean, the world with the financial institutions, we have some views on indeed some movements. But a little bit back to what has been said earlier this morning, I think it's more a gradual evolution, a gradual erosion of the dollar. There is no really very strong shift, but we do see that when, financial institutions are redeeming their securities in dollar, instead of replacing them by dollar securities as it was in the past, they start diversifying their portfolio. And also when I was traveling to Asia last year, Europe was always an anecdote. Now Europe and the capital markets in Europe start to become again back on the agenda of the financial institutions in Asia. What we also see, and that's also a movement which is very gradual, in the past when investors in Asia were going outside the domestic markets, usually they were going to the US market first and then to the Western world. Now we do see that there are more and more investment flows within APAC countries. So when they get out of their economy or the country, they go closer, and not necessarily to the dollar. So I wouldn't say that dollar is, completely losing and there are a swing, but there is a gradual, revision of the portfolio allocation. There are also, for example, what is also interesting because that's newer, there is also, a usage of more European players. Some people, used to very much work with U.S. custodians, U.S. investment managers. Now they start also to diversify. So I would say that the game is about hedging and about diversification.
Jenny, I saw you nodding as Valerie was speaking. When you look at flows, are you seeing the same sort of thing?
Well, I think you got to remember, over the last 5 years, the U.S. market has been so strong, right? Since 2022 with a couple of hiccups. I also think part of this is a little bit of rebalancing. And then it all depends on your perspective. I mean, if you were in Europe and you invest in the U.S. market, even though this has been a pretty strong market this year, you pretty much were wiped out because of the depreciation of the dollar. So I think part of this also is where you sit, because currency is always a risk that you have to weigh into your portfolio. But I think that, I also think like U.S. investors are looking around the globe as well to say, where are there other opportunities that we should be thinking about? A third of our clients come from outside the U.S., and so our view is we have to have the right products for all markets. So you might get U.S. investors who say, well, I'm not going to invest in China and technology because I'm worried that there may be a policy change. On the other hand, you have Asian, European, Middle East investors who say, look at how the performance of the Chinese market. I think there's great opportunity, great innovation here. I want to invest here. So I think a lot of it depends on your seat.
Deanna, we had this Liberation Day moment, and the way the market reacted, I think, was different than a lot of folks thought it would. And I'm curious what you make about that as I talk about signal moments in recent history. What did that portend? And then picking up on that, the level of uncertainty that we have in the U.S., I'm curious how that has led investors to look to Asia, look for opportunities here in a way that they might not have before.
Interesting. It's like, a very similar experience to Valerie and Jenny. Since Liberation Day, we have found that global investors, but mostly those outside of the U.S., have a mindset of every incremental dollar to their savings pool, they want to try to invest it outside of the U.S. Right? And so I think that it's not about the end of U.S. exceptionalism. It's not about turning bearish on the U.S. It's just about understanding that, all these assumptions in the past where the U.S. was just the deepest markets, most liquid, easiest option, and the most, the best performing asset class. I think that was that wake-up call to say, maybe you need to stretch a little bit more to add a bit of diversification to your portfolio. Which then brings me to your point on the increased complexity, which to Valerie's point is the hedge is diversification. As in, policy is going to continue to evolve globally, and every country has to, end of the day, look after its voters. And the policy that you see in China, which has had, zero inflation for the last 3 years, versus the US, Europe, and Japan, which today are maybe on the cusp of doing more stimulus. Right? So you see these two extremes. As in here, you have no inflation in China, where the theoretical textbook on economics you should be stimulating, right? But they're not. And over here, you have inflation. For the US, 3% inflation. I mean, US inflation has been above the so-called target of the Federal Reserve, of 2% target for the last 5 years. And you're still doing the same amount of easing and fiscal spending and more stimulus. Right? So then I would say, one needs to compare, and I wouldn't suggest trying to pick winners or losers, but just diversify your bets.
Valerie, you brought up the rule of law a moment ago, and we had President Trump just a few hours ago in the Oval Office once again talking about Fed Chair Jerome Powell casting aspersions at the U.S. Central Bank. Obviously, there's a lot of uncertainty in the country broadly, but there's uncertainty over Lisa Cook's position on the board. What do your clients say about that the U.S. had been this bastion of having a very rules-based order when it came to central bank policy and others? Now that's eroding. How much does that weigh on them? How much is that a part of the conversations that you're having?
Well, I think it's definitely an area of concern because, indeed, for 60 years or 80 years, the markets have been driven by, very certain legal regime. Really based on the independence of the different central banks. So I would say that it is an area of concern, and this translates also very quickly on volatility. I mean, when there had been this debate about Powell, well, you could immediately see, of course, the volatility in the securities business. So I think it's definitely an area of concern. And, gradually, I mean, all these questions about legal regime, about certainty that people had when they were investing, I don't think it is something positive for the financial markets. And that's something with which the politicians have to really realize, that you don't play with the trust as such. And when you see, I mean, I'm European, so when you see the gigantic amount of financing that Europe needs, because we're talking before about the European sovereignty, the necessity to invest in defense, in energy, in digital, name it, climate changes. It is at the time where politicians also need to understand that they should not, threaten investors. On the contrary, and so I feel that sometimes this is a little bit overlooked.
Jenny, what about the Treasury market in light of all of this? Can't talk about the kind of depreciation of the dollar without getting into Treasuries, and I'm curious sort of what you're seeing there and how much anxiety that brings up for you as we see that debt grow in the degree which Danny was talking about a moment ago.
Yeah. Look, I mean, I think the U.S. deficit is a concern, right? But it's not a concern until it becomes a problem. And so I think that it's proven to, like I say, the Fed can control the short end of the curve. They can't control the long end of the curve. And, of course, the concern is, if the U.S. is adding $2 trillion a year in debt, and Japan and China are two largest external holders of U.S. Treasuries, and they haven't been increasing, and between the two of them, they basically own about $2 trillion. You're going to have to find buyers. The good news is it's still sort of viewed as the risk-free investment. So it's more around what's the price that you get buyers versus, any kind of failed auction. So I think that it's still, my worry is over the longer run, does it crowd out other investment opportunities, not that the U.S. can't get funded?
Danny was talking about gold, non-fiat currencies. I want to ask you about digital assets, digital currencies, and maybe inelegantly wed this to Treasuries. So there is now, it seems like, more interest in stablecoins, and it strikes me that if that persists, that would be good for the U.S. Treasury market. How do you think that through? Yeah,
the funny thing with stablecoins is it basically shifts funding to the U.S. Treasury away from the consumer in a bank, right? Because what are you competing with? You're competing with bank deposits, bank checking accounts, right? And so the stablecoins are mostly backed by U.S. Treasuries. So for sure, and I think but the number's still like 300 billion or something in backed on the stablecoins. And so, I think the longer term question is, do the banks use the technology there of blockchain to then be part of their deposit mechanism, and does it shift it back to the bank balance sheets? I would get worried if too much money left banks into the stablecoin market, and such that the funding mechanism is the U.S. government versus the end consumer, right? Because what do banks do with that money? They go lend to people. They lend to corporations. They lend to individuals. And so that's where I think more of the stablecoin issue. And then I thought you were going to sort of on the Bitcoin as a diversification on the reserve currency. Look, I used to be negative on Bitcoin in the sense that I'd say, well, as soon as it gets too big and threatens the U.S. dollar, then the U.S. will just make it illegal, like China did. But then kind of came around when I talked to folks. I remember talking to somebody in Israel who said, my parents and grandparents had the government take away their money, they'll always keep a percentage in Bitcoin. Not in Bitcoin ETFs, but Bitcoin keys, where nobody can get to it. I had folks in the Middle East say, if I say the wrong thing, I worry that my accounts would be frozen. So it is still a fear currency that is out there, and markets, big buyers in Turkey. Countries with big inflation, you tend to get big buyers of Bitcoin. So I think that is still, it is a viable currency, but not a threat to the dollar.
In the minutes we have left, let's look forward a little bit. And Danny, I think we all agree here that reports of the dollar's demise or displacement are greatly exaggerated, to borrow a phrase from Mark Twain. But I'm curious sort of what the world looks like. I think we used to talk about the dollar being displaced by another currency. Now it sounds like there's going to be more, in all likelihood, more fragmentation in the global currency market. What is the effect on that for investors? If we don't have one currency that's occupying by a yard a place of primacy, what does that mean for investors broadly?
I think most countries will have to continue to do significant fiscal deficit spending, right? Like in the US, in Japan, they're just about to embark on stimulus as well. In Europe, there's a lot of investments that need to be made. And then the question is, how does the government fund it? And during the last two crises in the GFC, followed by COVID, they always started the quantitative easing tool, right? And today, even in the US, they have just stopped quantitative tightening. And I believe in the next 3 to 6 months, very likely to start QE again, because you need to do that in order to keep funding rates low, or the deficit just continues to balloon even faster. So I think that, number one, my view is QE is here to stay, or in some ways the stealth modern monetary theory, which has happened in Japan. In Japan, the Bank of Japan owns, at the height, half of all the debt that was outstanding by the Japanese government, right? In the US, at the height, it was about 30%. It's fallen to about 13% right now, but it will go back up, right? So, and this means that ultimately you don't want to be keeping your savings in fiat, that you want to invest in something that has any form of scarcity, right? So it could be gold, it could be Bitcoin, it could be, high-end real estate and equities as well, right? And so I would say, again, for me, the long run is most governments will have no choice, especially if we have more job disruptions down the road, with technology. Then you need more, essentially, universal basic income. And to fund that, you need to print.
Let me ask each of you a question about exorbitant privilege. And I go back to what the foreign minister said this morning, that the U.S. has played this role of kind of beneficent hegemon for a very long time. Valerie, talk a bit, if you would, just about the burden of having that exorbitant privilege. And I'm genuinely curious if you think it's something that maybe this administration, maybe there are people who think the U.S. should slough off. Maybe it's not worth it. I'm curious how you think about that.
Well, I think it is true that the US has provided the markets. When you see the ecosystem in the States versus the European, for example, it's striking to see that the depth and the breadth of the US market is really overpassed, many of the other parts of the world. Now, I think the arrival of Mr. Trump has created a wake-up call for Europe. We talked for many years about capital markets union, so now we're shifting more to savings and investment union. But it's not the change of name which matter, but it is the realization that there is a lot of money in Europe. You have a lot of savers, you have 13 trillion of savings in Europe, but it is not used really to fuel the economic agenda. And so there is a need to transform European savers into European investors. I think that's crucial for the European autonomy, but it will certainly require some time, because there is a change of market organization, there is a change of society, there is a necessity for a financial education. So unfortunately, I think that it will take some time. But I believe that going forward, you will have more and more, regional pools, but it will still be important to continue to interconnect these different pools of liquidity, because that's also how the economic, growth is about, so.
Jenny, picking up on that, I wonder if you could make the case for dollar dominance at a time when I think that there are people in Washington who don't understand it fully. So maybe you could give us your perspective on what would be lost if it were to erode further. So we've talked about all of the deficit spending that's underway, the comfort that brings policymakers, in part that they're able to do that. Were it to vanish, what would that mean? Why is this something that policymakers in Washington should be fighting for at a moment when it seems like there is erosion?
Well, first of all, it's cheap financing of our debt, which is,
Sure and simple.
yeah. we could not possibly operate as a country without, and already you look at the percentage of the U.S. budget that's now going to pay interest payments. If that goes up, it really crowds out everything else. And then the only thing I would say about Europe, the Draghi report comes out, how much was really addressed? Is Europe really going to stomach the reforms that it needs to do to be able to compete? Honestly, how many German entrepreneurs ended up in the U.S. because they'll say, I can get capital there, I can get innovation there. It's not that the talent isn't there, it's just that the market isn't there and the mechanism and the regulatory environment isn't such that people can be successful there. And so if you look around the world, I mean, it's really U.S. and China that has the great innovation that's happening.
But let me still be hopeful.
You can still be hopeful. And every European I talk to is like, yes, but. And I'm like, yeah, well, show me one. That's staying there.
And as a European player, we are trying to do all our bit, so.
But it's still a fragmented market, which is what's difficult.
Daniel, I'll give you the last word here. I started by asking these two guests just about the moment that we're in. How do you see the stakes of this moment and where things are headed from here?
I think you have to contrast the lack of inflation in China or deflation versus inflation in the US and the rest of the world. And take a step back and see that it's ultimately about political will, right, in terms of what the government wants to achieve. That China has no inflation because they took active action to deleverage 3 years ago. Not great for capitalists, but actually good for the general population. And now the question is, does the West have that same will to bring down deficits, to bring down inflation? Or, the most likely easy out, politically easiest option is to just keep printing money.
On that note, thank you all very much. I appreciate it.
Thank you.